right, everybody, welcome back to Bloomberg Markets. Carol Massar along with Romain Bostick and Tim Stenovec live on radio, TV, YouTube, and on Bloomberg Quick Take. And we want to talk a little bit about the U.S. housing market because continuing to soften, we see the impact of those higher mortgage rates, and it continues to put pressure and really make it tough for both buyers and sellers. We got some data points today. So let's get to it with Pierre Debbas. He is co-founder and managing partner at Romain Bostick, and they are a boutique real estate investment firm. So they are working with buyers and sellers. Pierre, so timely to have you here on this Tuesday. Real estate market, you deal with commercial, you deal with residential. How would you describe it right now?
You know, Carol, it's great to see you and happy holidays.
Yeah.
At the moment, the best way to describe the market, both on the residential and commercial front, is a pure point of stagnation. Interest rates clearly have almost tripled in less than a calendar year, which you can imagine, you know, real estate is one of the segments of the economy that's most interest rate sensitive. And for the time being, you know, it takes roughly a 6-month cycle for valuations to adjust to factor in economic factors like the rapid rise in interest rates. And during that time period, and potentially even longer, given how drastic this has been, everybody's going to sit on the sidelines, both sellers and buyers. And we're seeing that across the board. The last 2 quarters have been beyond indicative of that. Right. And I anticipate at least the first 2 quarters of 2023 will demonstrate that as well.
Even with the traditional spring selling season, you think that that's going to still be impacted, even though we have seen mortgage rates moderate a little bit, even though we have seen prices, for that matter, moderate as well?
You know, Romain, I'm hopeful that the spring season, you know, kind of counteracts a lot of the negative impacts of what's happened. I'll be honest with you, you know, one of my biggest predictions is that we're going to have a low single-digit decline in pricing over the next year. And actually, Fannie Mae's economist came out with a prediction of 1.5% in the housing market decline next year and 1.4% in 2024. So when you factor in things like, you know, inflation increasing the average cost of living by $500 to $1,000 per household, interest rates almost tripling, you know, the impact on your inability to save money to put down, the uncertainty of the labor markets, you know, this poses a huge problem for demand and activity in the housing market. Now, the reason pricing won't come down, because what you're alluding to is why wouldn't pricing adjust even more? The reason being is that we have just a tremendous shortage of supply. And at the end of the day, even with the reduction in demand and all the factors I'm describing, we're seeing, you know, we're confident that pricing will still be fairly stable.
Is New York, though, a unique market? I mean, you've already seen some double-digit declines in other parts of the country, in the Sun Belt and parts of the American West, for example.
For sure, Tim. You know, New York's a bubble, right? Like, for instance, I'm a real estate lawyer, and we have a mid-sized law firm in Midtown Manhattan that specializes in real estate transactions, with our primary niche being in New York City. And the great thing about that is that New York City oftentimes is insulated from, you know, the turmoils of the economy just due to the high level of affluency. But even with all that, I'm seeing transaction volume down 35% from where it was at the beginning of the year. And that's a terrible reduction in encounter in a short period of time. And again, you know, when will that, you know, uptick back to more normal levels? No one knows.
Hey, Pierre. So, you know, there was a lot of discussion, certainly by all of us here at Bloomberg, about what lasting impact the pandemic would have on commercial real estate in particular, whether it's retail, whether it's office buildings. What is sticking? What is not?
You know, I'll tell you now, what I'm seeing is small box retail is doing exceptionally well, specifically in New York City, because it's a good opportunity for small businesses to come about, lock in space at a favorable term, favorable rates, and to, you know, the city is vibrant as could be, right? The workforce isn't back. Only 50% of the workforce is in, but the city itself is vibrant where people are out 7 days a week. Now, larger box retail was in a precarious position pre-pandemic. I think that this only compounds that problem. What we are, you know, the biggest issue that we're going to encounter in the commercial real estate market is the future of office space. You know, the future of office is still completely undetermined. Even now, you know, I keep telling everybody we're in year 3 of this, right? Like, this is part of this is a new normal.
Right.
And when you're in year 3, we don't have half of people working from home because they're worried about virus anymore. It's just a way of life for many people. And companies have adapted and downsized and taken advantage of the opportunity. Others have doubled down and taken on more space, realizing that, you know, you can only build a business in reality by, you know, collaboration and being together in person.
Pierre Debbas, always great to check in with you and chat real estate here in New York City. Pierre Debbas is co-founder and managing partner at Romain Bostick.